Welcome to this latest edition of our Fixed Interests podcast series. My name is Brian Coulton. I'm the Chief Economist here at Fitch Ratings, and I'm joined today by Alex Muscatelli, the lead author of the report Tariff Hikes Under Renewed Trade War Would Adversely Affect Global Output. This report describes the potential impact of a renewed trade war could have on the global economy. Alex, do you want to talk briefly about the motivation for this research?
Thanks, Brian. We're just about 6 months away from the US presidential election, so we're thinking about the impact that changes in economic policy in the US may have on the global economy, especially in the case of a second Trump term. Trade policy is one area where Donald Trump has been quite outspoken about the desirability of higher tariffs, not just on China, but also on other trading partners of the US. And in particular, there have been reports of a 60% tariff on Chinese imports and a universal tariff of 10% on all imports. Moreover, we have the experience of Trump's first term, which saw a trade war with China and more generally a rise in protectionism not seen since the 1930s. All in all, it looks like the threat of a renewed US-led trade war under a Trump second term is a risk that we should take very seriously.
Yeah, absolutely. One thing that's really striking when you look at the Trump policy platform is how central trade protection is as a priority. There's this deeply held belief that low US tariffs, greater openness to trade than its key trade partners, are the primary driver for the widening of the US trade deficit since 1999. And that widening of the trade gap is in turn seen as a driver of the relative decline in US manufacturing, seen as highly detrimental to the US, including from a national security perspective. In this context, Trump team sees tariffs as a key policy tool to support the reshoring of American manufacturing, production and jobs. Now, we saw these beliefs actually translate into aggressive tariff hikes under Trump's presidency, and we think further sharp increases in tariffs would be highly likely under a second Trump term. Now, that's despite the fact that the US trade balance has continued to widen in dollar terms, even though the tariffs have stayed in place under Biden, and that most economic research has concluded the impact of the hikes imposed in 2018 and 2019 was adverse. Now, the main moves that we saw then were on China, and they followed an investigation into unfair Chinese trade practices. The US imposed tariff increases on roughly $350 billion worth of goods under 4 separate lists over the course of 2018 and 2019. The weighted average tariff rate on the goods affected increased to about 19% from just 3% in 2017, and it covered around 2/3 of total imports from China. It wasn't just China that drew Trump's attention, though. He threatened on several occasions to impose tariffs on all auto imports and an across-the-board levy on imports from Mexico, despite the USMCA having already been signed at that stage. And one thing that's appeared in Trump's rhetoric is trade diversion, whereby China has allegedly redirected its export supply chains to the US via third countries so as to avoid the tariffs. So in that context, we have to take the threat of the universal 10% tariff on all imports pretty seriously, although it's much more complicated than just on China. Now, nearly all of the available empirical research into the trade war in 2018-19 concludes that the effects on the whole were adverse, with moderate declines in GDP, about 0.2-0.4% US GDP, negative impact on employment and an increase in prices. And one pretty important and incontrovertible finding is that the burden of higher tariffs did actually fall on the US economy. So Chinese exporters did not lower their prices to offset the higher tariffs. They were passed on either to US consumers or absorbed by US importers in their margins. So given this background, Alex, how have we thought about estimating the impact of a renewed trade war from next year?
So, to estimate the potential impact on the global economy of a renewed trade war, we conducted a series of macroeconomic simulations using the Oxford Economics Global Economic Model and compared the results to a baseline of no further change in trade relations. The model includes a series of tariff levers, and we changed these to simulate the effects of higher tariffs and did so by modeling 4 scenarios on an increasing scale of intensified trade tensions. In the first scenario, we assume a hike in tariffs on Chinese imports of up to 60%. We assume that the latter would only impact the goods that were subject to the tariff rises since 2018 and that you mentioned earlier, Brian. We estimate that this would increase the average tariff on Chinese imports by around 22 percentage points, from around 11% to around a third. In the second scenario, in addition to the hike on tariffs on China, We have the 10% tariff across the board on imports from all other trading partners, modelled via an increase in the average tariff rate of 7 percentage points on goods from the EU, Japan, Korea, but also Canada and Mexico. The third and fourth scenarios build on the first two by assuming retaliation by the US's trading partners. In scenario 3, we assume only China retaliates, simply through a mirror increase in tariffs applied on imports from the US. And finally, in scenario 4, we add a mirror retaliation from the EU, Canada, and Mexico. All the scenarios assume that tariffs increase from the start of 2025 and remain in place for 4 years.
And so what do the results show?
Well, let's start from the US. Higher tariffs would lead to a shortfall in real GDP growth compared to the baseline of no further protectionist action. In the first two scenarios, the impact on US real GDP is relatively moderate and concentrated in the first years following the hike. We are talking about 0.4% in scenario 1 and 0.8% in scenario 2. The shocks are not very persistent. In fact, the level of GDP by 2028 is not very different from the baseline. In scenarios 3 and 4, though, where other countries retaliate, the growth shortfall is larger, given the sharper slowdown in global demand, and more specifically the impact of tariffs on demand for US exports. In these scenarios, the shortfall in real GDP peaks at 0.7 and 1.1%, respectively.
One just really basic question, Alex, getting away from the numbers as such. What exactly is US GDP lower in the simulations? Won't US industries be better protected from foreign competition? And won't that boost their demand for jobs and incomes in the US?
Well, those industries that face less competition thanks to tariffs may see more sales, that's true. But tariffs, especially on a very broad range of imports of both intermediate and final goods, constitute an adverse cost or price shock for US importers, producers, and consumers. This will increase production costs across the economy, lowering demand by both firms and consumers, also adversely affecting employment. And so all these factors would outweigh the gains in the protected industries.
So what happens to inflation in the simulations?
Well, higher tariffs mean higher consumer prices, at least in the short run. The impact of the simulations on consumer price inflation is largest in scenarios 2, 3, and 4, with annual consumer price inflation at the end of 2025 on average 0.4 percentage points higher than in the baseline. But over the medium term, the impact on inflation would actually be negative, as weaker demand translates to lower price pressures.
So quite a sort of complex impact on inflation with differing impacts in the very short term to the medium term. How does all that pan out in terms of what it means for the Fed?
Well, this weaker demand in the medium term implies that US interest rates will be close to or lower than the baseline, despite the short-term upward pressure on prices. In the worst-case scenario in particular, the Fed funds rate is expected to be 0.8 percentage points lower at the end of 2026 than it would have been otherwise.
Okay, so that's the US impacts. What about the impact on the rest of the world?
Looking at the impact of tariff rises in other countries, and in particular on the US's main trading partners, the general picture is this. The impact on economic activity tends to be lower in the short term compared to the US, but more persistent over the horizon of the simulation scenarios. In the first scenario, China unsurprisingly sees the largest hit to GDP by quite a distance, rising to 0.9% by 2028. In scenario 2, it's not just China, but also other countries that are hit by tariffs, and the largest shortfall that we see are actually in Canada and Mexico, countries that have the largest exposure to trade to the US as a share of their GDP. Now, when we think of the impact on the global economy as a whole, this is larger in scenario 3 and 4, when there is what we can think of as a full-fledged trade war. In the worst-case scenario of a retaliation by all trading partners of the US, the impact on our measure of world GDP would be 0.7 percentage points. Looking through the major economies, the impact at the 4-year horizon ranges from relatively small impacts of 0.4 to 0.6 percentage points in Spain, UK, France, to shortfalls greater than 1% in China and rising to 1.6 and 1.9 in Canada and Mexico. Now, apart from the Fitch 20 economies, the impact of the simulation scenarios would be significant also in APAC economies with particularly strong links to China, such as Vietnam, Taiwan, Thailand, and Hong Kong. Vietnam in particular would see shortfalls similar to those estimated for Mexico. So the conclusion of our scenarios are that aggressive tariff rises are likely to result in a reduction in US and global output in comparison to a baseline with no further increases in tariffs. And our findings confirm the direction of the empirical evidence that we saw for the trade war of 2018-2019.
Thanks, Alex. So really not very many winners at all in this. Thank you very much for that, and we will close our podcast here, and thank you very much for listening. For more information on our ratings and research on sovereigns and global macroeconomics, please visit us at fitchratings.com. We hope you will join us for the next edition of Fixed Interests.